Okay, hello everyone. Welcome to our Search and Matching in Macrofinance seminar. Today, we're very happy to have Laura Veldkamp presenting her joint work with Simona Abbis on the changing economics of knowledge production. We would also like to express our special thanks to panelists who can join us today. Just as a reminder, Laura will present for 60 minutes, during which our panelists can ask live questions. And for attendees, you can ask questions in the Q&A window, or you can also raise questions at the end in the 15-minute open discussion. Okay, Laura, I will give the window to you.
Okay, great. So thank you very much for inviting me to present to this group this paper, which is The Changing Economics of Knowledge Production, and it's joint with my colleague here at Columbia, Simona Abbis. So there's a lot of hyperbole about big data and artificial intelligence, machine learning, all of these new data technologies. And one of the claims out there is that big data technologies are the industrialization of knowledge production. So we're going to look at this with a critical eye and ask, is this accurate? And let's try to measure it the way that economic historians might think about industrialization and just see, is that even remotely true? So what does it mean to be like industrialization? Well, the way most people think about industrialization is that it changed the factor mix, right? It changed the relative intensity of labor and capital. And so we're going to think about whether machine learning, we're going to use the term AI, and we don't really mean specifically just the technologies known as artificial intelligence. We're really going to mean a suite of big data technologies. Anything that is a new data technology that involves a large amount of data as an input, we're just going to call AI for a shorthand. So we're going to ask, is AI in that broad sense doing the same thing? Is it changing the factor mix? And almost surely, there's more data going on, being matched with one person to create knowledge. But how much, right? Is this a little bit? Is this like the magnitude of what was going on, the shift we saw during industrialization? And how big exactly this is not a small matter. It matters for employment. It matters for what's the labor share of income versus the share of income that goes to the owners of data. It matters for, what's the optimal firm size, and therefore for issues relating to market competition. So this is an input into a lot of the big issues of our time that we think might have something to do with the data economy. So we're going to think about data being used in conjunction with labor to produce knowledge in a particular industry. And we're going to look at the investment management industry in finance, not because it's the most important or, it's just a good laboratory. Because first of all, it's really about producing knowledge. Knowledge is not an intermediate input into, lots of other things, but most of this sector is about predicting what will be high return assets and then investing in them. So there's a fairly direct link from producing knowledge to producing profits, but also because it's an industry that's been an early adopter of this technology. So, many industries use AI just a tiny bit, maybe, the one front runner in the industry has begun to experiment with it. But this is, as we'll see, a sector where many of the main players have adopted some form of AI machine learning technology. And so we'll be able to see more clearly what's going on in this early adoption industry. So we're thinking about a process for our production process will be to start with raw and unstructured data. And then there's a processing stage. And we'll see in the hiring that there are people who do cleaning, structuring, and warehousing of data. And there's a lot of labor input into that. And it's a very distinct job. And they produce structured data sets. So, the way to think about this is, many of you have purchased some data, right? And it probably was already structured. It probably wasn't completely unstructured. You purchased some structured data. But my guess is after purchasing that structured data, you couldn't immediately just stick it into, Stata or Excel or whatever, Python or whatever your favorite program is and hit run and estimate your results. You need to do a lot of work for it to prepare it for your own purposes, right? And that's what these data processors are doing. So they're producing a structured data set that's ready for the analysts to use. And then the analysts are the ones who decide how to take that structured data and turn it into knowledge or action recommendations, if you will. And there are two ways to do this. They can use it they can do this using old technology, which we'll think of as like, using Excel or using Stata, or where the person is choosing the statistical model to use, or they can produce knowledge with a new technology. Both of these take in data and labor, but they'll combine them in different ways. Okay, so that's the view that we're going to explore. And what we're trying to ask is, how different is F old from F new? Okay, so that's the whole introduction. So let's get into it. This is a model for the purpose of estimation. So it's not every whistle and bell that you want on there. It's a minimal structure that is designed for the purpose of taking it to data. So we'll think about knowledge that can be produced using either an old technology or this new technology, which we'll call AI. And the same data can be used as an input for both technologies, but they have differently skilled labor and they have different Cobb-Douglas exponents. Okay, so knowledge, this is the same knowledge, this is substitutable with this knowledge, but it's going to be produced in a different way. So the knowledge that was produced using the AI technology is, well, that's just our total factor productivity term, and AI just denotes that it's for this technology. It involves data raised to the alpha and labor raised to the 1 minus alpha. The knowledge produced with the old technology has its own sort of TFP term that we'll estimate. It has data raised to the gamma, and it has a different kind of labor raised to the 1 minus gamma, because we're going to be looking at job postings and estimating how much little L labor, the old technology labor, does this firm use, and how much of the big L, the AI technology labor, AI skilled labor, does this firm use.
Laura, can I ask you a question?
Can I ask you?
Oh, sorry.
Lucas first. You want to go?
Oh,
yeah,
well,
go
maybe
ahead,
it's the obvious question. I'm just wondering why you're assuming constant returns to scale here. Is this an assumption that is necessary for estimation, or could you have different exponents on all four of the terms?
You could. It's going to be harder to pin down what are the equilibrium wages, right? And so I think we're going to take this as an approximation that if you double data and doubled labor, that you could come up with approximately twice as much knowledge, with the idea you could execute a replica economy here.
Yeah, but for the Industrial Revolution, the motivating example, when I teach about that in class, it's kind of obvious that you can, maybe to us, maybe not to the students, but you can duplicate the economy. With data, it's just less obvious that there is a duplication argument.
Great. So what we're not ruling out is that there's increasing returns to knowledge. Okay, so knowledge you could think of as now an input into some other sector, and knowledge could have increasing returns. So I think we could deal with that. I won't need, we originally started this project as, writing knowledge as an input into some profit production function. It turns out we don't need to make assumptions about what the structure of that part of the economy will be. Knowledge here is the amount of knowledge that will generate you, $1 worth of profit. But you could imagine knowledge as having increasing returns itself, so that knowledge applied to a firm with, say, more financial capital would generate larger returns. And that's not incompatible with this structure. So we can build in increasing returns. I would just do it, with the K part of it, and not the piece that's about how knowledge is produced.
So I was going to actually, this is similar maybe to the other model you had, but throughout, I think. So I was wondering, why are you focusing on the factor shares as on the inputs to knowledge, as opposed to the factor share of knowledge as an input to other stuff, if you see what I mean? Because I like your argument that in investment management, knowledge is most of the game. So we can kind of assume that share was pretty high to begin with. But, still, I mean, there's marketing and there's onboarding of new clients and all that stuff that matters a lot for investment managers. And maybe these days it matters less because it's all about who has the latest AI. So I was just wondering how you think about that.
Okay, so I think that's a great question. I'm glad you're interested in it, because I have other papers that as you pointed out, the work with Venki and Mariam and Adrien is more about how do financial firms use knowledge to generate profit. and how can we value that, put a price on that stock of knowledge. We call it there a stock of data, but really it's a stock of knowledge. It's actionable insights. So I don't think that that was the right foot. If you take as given, you know, I get to choose the question, right? So if my question is this like the Industrial Revolution? Then asking, you know, how is knowledge used by financial firms, and maybe differently for big ones and small ones, is not essential to answering that question about, and, you know, is this like industrialization? And I'm really interested in the question, how did it change the factor mix of how data and labor are combined? So for that purpose, this seems like the right, you know, the right level, the right point in the production process to focus. But I completely agree with you that the question of how knowledge is used and what value we put on it is interesting and, you know, at least as relevant. Does that answer your question? Okay, great.
Sorry, could I ask one more related question on this?
Yeah, sure. Go ahead.
So, I mean, if you're talking about factor shares and factor mix and changes, I would have thought like a more flexible production function than Cobb-Douglas might have been interesting. Like Cobb-Douglas is going to put a lot of structure on what can change the factor mix. No, it has to be the shares. Whereas like a CES, changes in A's would change the factor mix.
You know, we were trying to adopt a lot of structure and some very standard structure to be able to make inference from what little data we have. I mean, it's going to be a big data set, but it's not, you know, we can't observe knowledge. We can't observe productivity. We can't even observe the whole data stock, right? We're pretty much just going to be able to see hiring. So given that that's, you know, what's publicly available for these firms is limited, a lot of structure was really helpful. If you can see ways to take the data we have and estimate a more flexible structure, I'm interested in that. But, you know, that's our limitation, is that we're really trying to do this with hiring and wage data. Is there another question? I thought I heard somebody else. Yes.
Yeah, if I may ask another question about the production function in abstracting away from capital as an input, when it might be that with the AI technology that you need more ICT capital than the traditional one.
Yeah, so we wrestled a bit with that one. I think that, you know, the conclusion that we came, so let me make a distinction between this. We're not talking about financial capital that would be combined with knowledge. That could be in there, but that's further down the production chain. That certainly makes knowledge more valuable, but that won't invalidate our approach. I think what you're talking about is like the computers capital that, you know, these workers would combine with data. It turns out that computers are just not that expensive compared to financial workers. Right? If you hire a few analysts, that's just a way more than the computer capital. So we felt like that was small enough that we could ignore it for this purpose. Like the I don't have enough computers never seemed to be a limiting factor for financial analysis firms.
Maybe if I can jump in for a second, I think that it depends a lot what type of AI you're talking about. If you're thinking about, let's say, deep learning, I think that the whole revolution would not happen without the GPUs in 2012. So in some sense, there was like, if you want to capture this kind of like a jump, I think that the capital, the nature of the capital, CPUs versus GPUs, that could show up probably in the data, especially if you have before 2012 and after. But I guess that before 2012, I agree with you that probably like it was just basically CPUs, and then it wouldn't be like a big difference.
Okay, so I mean, the change in technology is going to be incredibly important here, and that we're going to estimate that when we estimate this AAI and AOT. So for sure, better computers that everybody has access to is incredibly important in all of this. It's just that, you know, whether one firm gets one of these computers, everybody can buy this stuff, right? We're talking about, you know, the Morgan Stanleys of the world are not saying, well, God, I'd really love to do AI, but I just can't afford that computer. No. I mean, it's a different, you know, the costs they're facing and the profits they're facing are just a different order of magnitude. So we thought that was fairly negligible. I think there is a way that one could try to make inference about this, which is to look at, we can't see the computer purchases directly, but we can see the IT maintenance staff and we could make some sort of inference about what sort of capital infrastructure they have, the sort of computing infrastructure they have, by looking at the maintenance staff that basically they employ to deal with depreciation, right? Because if you know depreciation, you can make a good guess about the stock. So that one's more doable, but still seems small relative to the magnitudes of these other types of workers that we were dealing with. Okay, so so let me just point out the D here. This is not raw data. This is structured, cleaned, machine readable, in a systematically organized database that can be queried by workers at this firm and used for their purposes. And so producing that kind of structured database requires labor. And that sort of labor is something different from either the new technology AI or the old technology analysis labor. We're going to call that lambda, and it also has diminishing returns. So we're going to think about new structured data is being added to an existing stock of structured data, and it's got a depreciation rate. So this just looks like our capital, evolution equations of a standard macro model, where tomorrow's capital stock, DIT, or tomorrow's data stock, is 1 minus the depreciation rate of today's data, plus the new investments. And what are these new investments? Well, these are these workers who are taking this unstructured data and putting it into the data stock with some level of diminishing returns. Okay, so that's the model. It's a 3 equation. Yes, please.
So you've sort of pushed the stock feature of knowledge out of knowledge and into the structured data. So I was just wondering if part of AI is kind of building up AI structures, which are then again stocks, which can work on your data structure without using any additional employment.
So if you want, think about K as being an inflow into a stock of knowledge. That's a good point. I haven't written that out explicitly because exactly how that stock of knowledge evolves is not crucial for my purposes. But I think you're right. K, you don't want to think about K as the entire stock of knowledge. K is what I've added today.
Yeah.
Okay, but it's going to have all we need is for it to have a marginal benefit.
Right. I was just wondering whether kind of in terms of the 2 technologies, the old and the new technology, the stock features are sort of different in terms of generating knowledge stock.
I don't understand. The stock features are different in terms of generating knowledge.
Suppose I have a structured data set, and with the old technology, I kind of have to rehire and use the same labor input again every period in order to generate usable knowledge. With AI, I just have to write the software, and then the AI software is going to work on its own on the data structure in order to generate the new knowledge.
Yes, that distinction is going to become very important when we start thinking about the rate of depreciation of data. And are we really talking about getting a point of data or a stream of data?
Yeah.
So that is useful to think about. I think, all of these firms are capable of hiring somebody who can, figure out what an API is and go get query a stream of data repeatedly and automate that process. I'm not sure that degree of sophistication is really what is going to distinguish our old tech from our AI folks, but maybe some of our old tech folks are really, manually looking up what's the unemployment rate each and every month. I would hope not. That seems pretty inefficient, but it could be, if that's going on, it's going to be more prevalent in the OT stock. So your point is well taken.
Yeah, it could be for the old guys too. I mean, they write the software, and if the software is really tailored to a particular product, you cannot really use it again. But if it's general software, you can use that again. It's never stock variable.
Right. So that's going to show up in these, in these labor exponents. How much, maybe that's going to make OT much more labor intensive because you need to look up this number each and every period and insert it manually and so forth. That would be part of what we're trying to capture. Okay, so this 3 equation model gives rise to a value function. And the value of a stock of data is the maximum of, yeah, here we go. So this AAI and D alpha, this is the knowledge produced with AI, right? And this is the knowledge produced with OT. We've normalized the price of that knowledge to 1. Okay, we could put a price in there, but it would just get rolled into this A thing. So think of A now as being a combination of productivity and price. Okay, we don't observe the price of knowledge, so we couldn't tease it out separately. Then you've got your labor costs. Oops, move my pictures out of the way. Here we go. We've got our labor costs, the labor of the AI workers, the labor of the old technology workers, and the labor of the data management workers. And then we have a discount rate times tomorrow's value of the stock of data. Okay, so that's what the firm's trying to maximize, a simple Bellman equation, and they're choosing these three types of labor: the data management workers, the old technology workers, and the AI workers. So that gives us some first order conditions. Notice that these are these standard conditions about the share of income, right? Here's the share and here's our income. This is what's getting paid to workers. It's that 1 minus alpha share, and the same for the old technology workers. Now for the data management workers, that sort of income share has the same spirit, but it takes a little bit different form because the value of data, data is an input into this other production process. So, here's the total payments to these data management workers, and it depends on, how much are they increasing the stock of data relative to what it was. It's almost like a percentage change. And then what is the marginal value of data as an input into these two types of knowledge, okay? But it's got the same sort of spirit, and it allows us to identify, these sorts of equations will allow us to identify these exponents, alpha, gamma, and phi. Okay, so those are basically what we're saying is firms are equating marginal benefit and marginal cost of workers, right? And so they're going to pay them, they're going to hire them up to the point where the marginal payment to an additional worker is equal to the marginal benefit of that worker. And that's the essential feature of our data that's going to allow us to identify these parameters. Now it's more complicated than that because there's other stuff we don't know, but that's the essence of the approach.
Laura.
Yeah.
So it doesn't matter that the efficiency of the workers that generate structural data is constant here. So you could imagine something that looks like an investment specific shock in a traditional macro model. Would that matter anything, or just at the end we'll read everything as efficiency units of those workers?
So we have these changing A's, productivity, but I agree that's not the same as like the equivalent of an investment specific productivity shock. So no, that's not something that we can identify separately. If such a thing is going on, we can't tease that out and get these exponents at the same time. There just wouldn't be enough, anything with an exponent, I guess, could be mimicked by some time varying sequence of, data specific technology shocks.
Yeah, because you could imagine something like that is going on as well. It just becomes easier now, for instance, to deal with unstructured data, text-based data. Kind of this efficiency of this workers probably increase over time as well. But I guess you're limited by the kind of things that you can observe.
That's good. If you want, think of these exponents as representing what's going to be, the labor or data share on average over the period we're looking at. Okay, so we're going to look at 2015 to 2018. So we're not, this isn't a huge long time series. 2015 is basically when we can figure out that a cat is a cat with AI, right? And before you can do that, people are playing with AI, they're tinkering with the idea, but they're not really making any money off it because you can't figure out a cat's a cat. You're not really going to invest with, put your money in this technology. And so, we're not talking about long periods of major technological transformation in the period that we're estimating from. But, think of alpha and gamma as being the average over that 3-year period. I agree, maybe it changes, but the average over that 3-year period of what's going on with the labor share and the data share. Okay. Okay. So there are a couple of challenges, right? This sounds easy. We've got 3 first order conditions, we've got 3 exponents, but we don't know everything, right? So we don't know knowledge. We don't observe firms' data stock either, right? So we don't even know one of these inputs, but we can infer it. And there are 2 different ways we can infer it, and that's going to help us pin down other features of the data we don't know. So this way of inferring it, this is basically the marginal benefit of data This is the marginal benefit equals marginal cost. That's how much data they should have. So if we knew alpha and we knew gamma and we knew how much they were paying their AI workers and we knew how much they were paying their old tech workers and all this other stuff, you know, that's how the optimal amount of data for this firm. This thing is just that investment equation, that accumulation equation. So how much data should we have? Well, the amount of data we had initially depreciated plus all the investments we've made in the data stock each and every period, each discounted, right? If we invested, you know, 3 periods ago in this data stock, we're going to depreciate it 3 times. Okay, so this calculation should
Laura,
give us optimality. Oh, hey, so
Laura, yeah, I have a question on the first order conditions and even on the marginal benefit here.
sure.
Those will depend on the decisions of the other investment managers. So in fact, no, what you are estimating at the end of the day, it will be a nice equilibrium of some sort, no, with the other firms. And so the marginal benefit should depend, no, on what the others do. So since you are taking just an approach, a single agent approach, I understand. So how would this change your estimation? Will this introduce any bias that you can think of if looked at it from the competition perspective? I don't know, maybe AI entices more competition. I don't know.
Right. Okay, so 2 things need to be true. The first is they know what the wages are, right? And that's going to be a sufficient summary statistic for knowing what their competitors are doing. And the second is that they're not taking into account the price impact in the labor market. Okay, so I don't have like a, you know, DWDL term here. What if I hire more people? Will I drive up wages? Right? That would change this. You know,
So you assume a competitive labor market for these guys, right? So
there's a competitive labor market for these guys. That's right. Now, you know, what they do with the knowledge and how they value it and whether they have price impact there, like knowledge could be the input in a Kyle model, for example, where somebody trades and has price impact in financial markets. That's fine.
Yeah, that's another thing. Yeah.
That, you know, that's within the bounds here. That still doesn't invalidate what's going on in the labor market, but they do need to be competitive in the labor market. Okay. Great. So there's one thing we don't know. So we get to see this, all this hiring of these data management workers. We're going to check out different depreciation rates, and we'll talk a little bit more about that and how we estimate that. But we don't know what the initial data stock of any firm is, right? We can accumulate up. It's like we see all the investments, but we don't know what the value of that initial capital stock is. Same problem we have here. So there are 2 ways that we can do this. What we end up doing is we express the initial value as a function of an average. So we're going to estimate this parameter for the market as a whole, and then it's proportional for firm I to their cumulated hiring between 2000 and 2014. Okay, so firms that hired more, if I hired twice as much as you did, we're going to assume that I started with twice as much data as you did. There are other ways we can do this that we've experimented with. We could start each firm in steady state and say, suppose they were just hiring for replacement, and we'll know something about, you know, the departure rates of these workers. And we could make an assumption that way. We've tried that seems to overestimate a bit. We've also tried just starting everybody at 0 and said, suppose at, you know, 2000, everybody's at 0. And now let's take all the hiring data we have up until 2014 and use that as a burn-in period. So all of these are tried. They don't make a huge difference in our results. This one seems to give us the most stable transition path over that period. So then we also, so that's about how do we get data, right? So we make some assumptions about initial data stock, and we accumulate up all the data management workers as if we were adding investments to a capital stock. But we also need to compute 2 productivity parameters. So we don't know what the productivity of old tech knowledge production is or AI knowledge production is. And those are computed from these first order conditions. So you may say, well, you can't use these first order conditions to pin down these exponents and pin down the productivity parameters. Well, we sort of can, because we've got one of these conditions for every firm in every period, right? So we actually have a ton of these first order conditions. So broadly speaking, what's going on is we're using the time series, the average at each point in time, to pin down these A parameters to get the level about right, and then the cross-sectional heterogeneity. So our firms that hire more let's say, data management workers and build big data stocks, are they hiring more AI workers, right? That kind of cross-sectional heterogeneity is helping us to pin down the exponents of the production process. Okay, so those first order conditions can do a lot of work for us because we've got cross-sectional and time series heterogeneity. Okay,
Laura, can I ask a question about the labor? So
yeah.
are there 3 types of labor with fixed supply in the model? Is it?
I don't know about fixed supply. We're going to see postings, and then we're going to convert those into hiring.
Okay, I see. So it's a partial equilibrium analysis. So we don't need to worry about, so in equilibrium, what determines the labor supply?
Yeah, I'm not modeling, and I am simply assuming that a firm equates marginal benefit and marginal cost taking a wage as given.
Okay.
Right, and I'm agnostic about what is the process that determines that wage, other than they have to take it as given, right? No DWDL, you can't influence it. Otherwise that would, yeah, that would invalidate, or at least would bias these estimates. Okay. It might even be not such a big deal as long as they didn't think they would change the wage in these 2 different markets differently. But that's sort of a speculation. So, okay.
Well, good
Yeah.
question. So
Yeah.
the productivity parameters, they are common across firms?
Yes, they are. Yeah.
But it's kind of, the productivity parameters are sort of shorthands in terms of how they feed, how the knowledge feeds in revenue generated, right?
They're shorthands for how knowledge feeds. I see what you're.
I find it's a very reduced form for that.
Mhm.
So wouldn't you expect that that is sort of firm specific?
So you're saying different firms will benefit differently from knowledge?
Yeah.
Point taken. Let me think some more about that.
Okay.
I'm not, yeah, I don't know what we can do about that, except for maybe to control for some features of firms, because I don't know that we have enough information to trace out how that firm benefits from that knowledge. But I agree, a smaller or larger firm might have a different internal price of knowledge. But then take this as an average, right? This is, you know, we're trying to figure out for an average firm, how different are KA, you know, how different is the production process that that firm faces for AI and for old tech. But I agree, there's more heterogeneity here than what we could possibly measure. And I think that's always true. So our data is job postings and salaries. These come primarily from, well, the job postings come from Burning Glass Technologies. We have these from 2010. We have a little bit of data back further than that, but the more comprehensive coverage comes from 2010 to 2018. We have more, they scrape more than 40,000 sources. These are job boards, employer sites. They collect non-digital sources as well. 60–80% of US job vacancies seem to be captured in here. That's based on work that Daron has done using this similar data. And they conclude that the finance and technology industries have even better coverage than average. So this is capturing a lot of the jobs that are out there. We're going to filter out a lot of these jobs. We're going to use postings that are in the finance industry, that are predominantly for investment management firms, and that hire at least 5 old tech or AI workers. And I'll tell you how we classify somebody as being one of those workers in this time period, okay? And they've got to have some positive number of data management workers as well, because it just doesn't make any sense if we don't think they have any data stock. So after we do all this filtering, our final sample comprises 209,000 and some job postings, 12,000 and some employer month observations for 305 unique companies. Okay, so there's a lot of heterogeneity, a lot of different jobs in different companies in there. So we're going to use this a little bit differently from how anyone else has used this same data source. One of the reasons is that we're focusing on a specific industry. And the reason that we need to do that is that it turns out to be quite difficult to distinguish a financial analyst who's using sort of older tech skills with someone who's doing the same job for the same firm with the same, objectives, but using a slightly different technology. So in order to make that more fine-grained division, it's helpful to have finance-specific vocabulary for these kinds of jobs and to base the categorization on the job full text, not the skills as identified by Burning Glass. So it turns out that Burning Glass, it does okay at telling you what skills people need, but they're not as careful as a assistant professor with a good knowledge of machine learning whose objective it is to really tease out every bit of information in here. It doesn't get as good a distinction. It doesn't make as careful distinctions between these. And quite frankly, if we just use the Burning Glass listed skills, we get junk. If we categorize it carefully using the full text of the job postings, we can do much better. So I guess that's also just a word of caution with anybody who likes using Burning Glass. Use these skills, but understand that there's just a lot of noise in them. So there's a master list of investment management firms. We identify these categorized job postings. Those are most likely to belong to these employers of interest. There's a candidate list of employers for each job posting. So this is about, how we got to know who's going to which firm, right? It's not just each observation is observation in of itself. We got to know, like, this data management person is producing data for this firm, and that's the same firm that hired this AI person. And the problem is, sometimes this is listed as, Morgan Stanley, or sometimes it's, JP Morgan, or sometimes it's Morgan, or sometimes it's, like there are lots of different job postings might have slightly different formulations of names. And we got to make sure, is this the same firm or not? So there's a bunch of work that goes into doing that. And so there's sort of scores for similarity and uniqueness of names and so forth. So again, this results in still a pretty big data set, but we have to, drop some that don't seem to correspond to any known investment management firm on the list. Okay, so this full text analysis is based on dictionary of words that indicate, data management or data analysis. And we look at their—
Wait, Laura, can I ask? You went a little fast. I just want to make sure I understand. So you don't actually observe who got hired. You have to try to infer that from the data?
Yes, I'm going to
do that by looking at, you said, the best candidate?
No. Sorry, this is just about, the last slide was just about matching a worker to a firm. Okay. I'm going to talk more about, these are postings and they're not hirings. And we're going to deal with that by using hiring rates and separation rates.
I see. Okay.
I'm going to adjust for that, but I haven't done that yet.
Okay, gotcha.
Yep. I'm still sort of telling you about all the textual analysis stuff. So we are basically, word frequency is what categorizes a job into one of these three bins. So these little pictures, these word cloud pictures, tell you about what are the key words that identify a job as being one or the other. So this little guy on the left, our little robot, keywords that get you placed in that category: machine learn, data scientist, data science, analyst skill, some mathemat. And some of those, like analyst skill, you can see also in the person, the old tech, that's the guy in the middle. So there's some overlap between, this is why it's difficult to disentangle these jobs, but there are also a bunch of words that are much more prominent in one of these pictures than they are in the other. And it's that relative prominence and relative frequency that allows us to distinguish these kinds of jobs. And then you can see the easiest ones to distinguish are the data management jobs on the right: data model, data manage, data quality, SQL server, data govern, data integra, and database administration, and so forth. Okay, so these are our what comes out of categorizing these jobs.
Laura, can I ask you something about this categorization? It might be a little bit biased by the fact I'm just teaching a class on machine learning and finance, and I have lots of students who would absolutely nail a job interview with your little robot on the left, right? They know all the data science, all that stuff really well, but they struggle with the economics, and they might not be super useful to a finance firm in their current shape. And I guess that's where I come in. But what I'm trying to say is, in this industry, there seems to be a huge premium for people who can do both.
Yes.
The robot and the human thing.
Yes.
The human finance thing. And I wonder if you can allow for that, or if this is just a hard 0-1 categorization in your data and in your model.
So let me show you what one of these job postings looks like, not the old tech, the AI one. It's clear that what they're learning for, what a lot of these jobs are looking for that combination. That doesn't mean that the reason those human words aren't showing up so much in those word pictograms is that they're not as useful for distinguishing between the two. They want people who know finance both for old tech and AI jobs, right? But I agree with you that absolutely it's the convergence of the two that's valuable. So let's see what an AI job looks like. So this is 2 Sigma, a posting from August 2018. They said, as machine learning and data-driven business intelligence have permeated industries, an abundance of new data sets and techniques have created opportunities for granular measurement of increasingly varied aspects of our economies. They're looking to hire creative and motivated lead data scientists. Let me jump down to the beginning. Their 2 Sigma data scientists are focused on joining, enriching, and transforming data sets into novel and creative measures of economic activity. I guess in the middle, it says something about integrate new data sets into a diverse ecosystem of syndicated finance and industry specific data products. I think this has some of these words that suggest that, you know, they're not just looking for a pure data science person, that they want somebody with, you know, with both sets of skills. So, you know, I think that's showing up in these kinds of job postings, but we're not emphasizing it as much, again, because, you know, our job is to make a distinction between investment management, or I should say analysts, financial analysts that are using one set of tools versus another.
Laura, a question about education. Do you observe the levels of education that they request? And then like, how do you distinguish between, let's say, PhD in computer science versus PhD in finance or economics, stuff like that? And in terms of the assumptions on the wages, do you assume that there is a single wage for regardless of the level of education, or you do have like a different wage for different level of education?
No, for right now, we're putting everybody with this set of skills. You know, the educational degrees will show up in the full text of the job, okay? And so those could be, you know, keyword, like it could be the AI, it could be our algorithm, you know, identified PhD as an AI specific word. It turns out not to be one of the most distinctive words to distinguish these jobs, but that was within the realm of possibility, okay? So the textual analysis did not seem to identify a level of education as a distinguishing feature, right? Which you could, there's still people who are doing, you know, financial modeling and have PhDs. That's what I take from that. You know, I would love to have a richer wage structure. We were at the limit of what we could identify with what we've got. We don't always have educational, you know, criteria in every job posting. And so we would lose a lot of data if we required that. But, you know, for sure it's there. I take your point that not every analyst who does old tech and not every analyst who does AI are the same.
I think that if you like unconditional the finance industry, what we looked into the visa applications, every time you get application for a visa, you need to provide like, you know, a wage range, and then you can see substantial differences across both AI and non-AI. It's like there's a big premium, and also like across, you can do it like by education level. So in that sense, I mean, there is like a substantial variation. Maybe it's not important at this level that you are analyzing, but it does seem to exist.
Yeah, that's true. Actually, so we have wage data now from PayScale, and actually that would allow us to do some of the more fine-grained segmentation of our data, or, you know, or controls or adjustments that you're suggesting. Yeah. Okay, I'm gonna pass on this. So let me get back to, I think this was Ben's question about, you know, how do we convert postings into stocks of labor? So we're gonna use separation rates from the BLS. We're gonna look at what are the NAICS codes of the job postings, and then we're going to take the BLS separation rates for each of those NAICS codes and weight them by the same frequency as those codes appear in each of these 3 types. So we're going to have different separation rates and different job filling rates, right? This H is the fraction of posted vacancies that are filled. And so then J are a job posting. So the stock of labor is yesterday's stock of labor times 1 minus the separation rate. right? Where the separation rate is specific to AI jobs because we're taking the nice code of every AI job and weighting the BLS separation rates for that code accordingly, plus the postings, that's our raw data from burning glass, and the vacancy filling rate for that type of job. These types of jobs tend to have very high vacancy filling rates because this is the industry that pays the most essentially for these skills, right? Nobody pays data scientists quite like finance does. So that's true for our AI job. We do the same procedure for old tech and the same procedure for data management, each with their own unique separation and filling rate. Okay, so that's how we accumulate up the stock of labor. There is, again, just like before, when you accumulate up, you need to make assumptions about what's the initial stock. Two possibilities: we could start everybody at 0, or we could assume that everybody is in steady state. We've tried both. In both cases, we use 2010 to 2014 as a burn-in, and we start the estimation in 2015. Okay, we're at 12. I'm gonna skip the specific example for 2 sigma. Okay, so this is this is just what's going on with the stock of labor. So I just showed you how do we take these job postings and accumulate them up to stocks of labor. So this is what these stocks of labor look like. So you can see by assumption, we set everybody to 0 back in 2010, but we're only using this piece for estimation. When we set everybody at steady state, everybody started like up here and we had a little dip, but then by 2015, these two estimates converged. And that's why we're using 2015 to 2018 as our data period. But so you can see lots of data management hiring, a good amount of old tech hiring, and AI is still a reasonably small part of this market. So this figure on the right is exactly the same as this blue line. We just blew it up because here it looks like there's nothing going on. It looks like it's all zeros. It's not all zeros. We do see a big jump in the 2015 to 2016 year as we start, this is exactly when technological breakthroughs are happening and this deep learning starts to work and this becomes more practically relevant for the finance sector. Okay, so wage data. We've got pay scale. They've got detailed salary information at the industry, job title, and skills level. We match this to ONET, to job titles, to in the employer job postings. So we've got to take this wage data and match it with our labor data. You can see the AI workers. The punchline here is that they're getting paid a lot more than the old tech and the data management workers. And that also sort of validates our job selection approach, that it seems like, the kinds of jobs that we're selecting out do seem to be more valued and higher paid. So this is salary and bonus. It's the total compensation. Okay, so we've got, yep.
One quick before you go there. How the jobs you're looking at, how much do they mark up in terms of total employment in that particular industry?
I'm trying to think about how to define this. So you're thinking about the finance industry or the investment management industry, or
you're looking at analysts in the investment management industry. So the question came up before, kind of how many people does this particular industry employ? And you have now constructed a series for kind of AI data management related employment. So kind of a rough idea of these occupations, how much do they contribute to overall employment, and say the overall wage bill in that particular industry?
Simona would certainly be able to give you a better answer to that. I'm hesitant too, because we were very conservative in the jobs that we included, right? So when in doubt, because we had a ton of data, when in doubt, we dropped it. So, we're left with a few 100,000 jobs. But I'm not sure I would say that is the fraction of people with these skills in this industry. I would say that's an underestimate.
Right, and if you were to kind of take sort of a broad measure, not using your data restrictions, what's the share of employment in that industry going to these kinds of occupations? I don't know if there is sort of a measure of average for the whole industry.
I don't know.
Okay.
I don't know offhand. I bet Simona could answer that question for you, but I can't say that I know that offhand, but that's a good question.
Yeah, thanks.
Okay, so we have a lot of equations. We're using nonlinear least squares. In each iteration, we back out some production parameters, and then we're going back and forth with trying to get, the productivity parameters, the technology parameters, these A's and our exponents. After we get this nonlinear least squares solution, then we use a grid search over a large area to check for global convergence and make sure that we're not identifying a local minimum. Again, what we're ultimately after is what are these production function exponents, alpha, gamma, and phi. We're using, obviously all moments inform every parameter, but what's particularly informative is the time series variation, right? If for a firm that hires a little bit extra in data management, basically they have a bigger data stock, are they hiring a little bit more AI, a lot more AI? What's the mix of AI and old tech that they're using? This is the kind of variation that's particularly informative for these exponents. And then the time series variation is really what's allowing us to pin down a productivity parameter. Okay. So let me make sure that I leave a little bit of time to tell you what we found and how we think about it. So we're going to think about a few different depreciation rates. We've got 3%, 5% is our baseline, 7.5%, and we go all the way up to 10. I think that that's a overestimate, and I'll tell you why. I think 5 or really 3 is probably a more appropriate way to think about depreciation. But ultimately, what we find is that the difference in the exponents that we have, alpha and gamma, is really quite large. So we're finding that alpha, the AI analysis rate of depreciation of data, is much larger than the rate of, not depreciation, the rate of diminishing returns. 1 minus alpha is like the rate of diminishing returns for data, right? So if we have 0.68, that tells us that this function is much closer to linear in data. So it doesn't have as much diminishing returns in data as does the old technology production function, which seems to have a lot of curvature in data. Makes sense, right? If you're using something like, Excel or Stata, and somebody says, here's 1 million data series, like, what am I going to do with that? I'm just going to crash the software. It's, the 1 million of first data series has 0 value. So what this tells us is AI has significantly raised the marginal productivity of analyzing additional pieces of data, which I think we knew, but it's a big magnitude. And it tells us that the labor share of income fell a lot. Well, I shouldn't say fell. There's a decrease. There's less labor share of income for these new technologies, and that this technological change is substantial. So people who look at the Industrial Revolution say that the capital exponent rose, something like 0.12, right? And we're finding something that's a lot larger than that. So this estimate suggests that it's not hyperbole to compare this to an industrialization type event. And let me point out that even if you go out to 10%, and this is 10% depreciation per month of data, you're still finding really substantial effects here. I think, that back to our discussion about, what does it mean to have depreciation of data? Are we talking about the depreciation of a data point? Or which, in a finance industry, you could think of like, somebody saw this order flow trade and seconds later, right, that everybody's traded on it and it's irrelevant, right? You could have almost a full depreciation of some sorts of data, in a day or two. But I think that's not the right way to think about it. I think the way you want to think about depreciation is somebody has automated a stream of data, right? What is it that a data management worker does? Are they, marching out there and picking the data point and plucking it in the data set? No, these guys are programming up automated ways of querying data. So what we're really talking about is how quickly does a stream of data that can be automatically incorporated in a data set become less relevant. And surely they do depreciate, they become less relevant over time. But that's a much lower rate of depreciation than a particular piece of knowledge, right? And so the way the accounting literature does this is that it depreciates this stuff at about 3% per month. So it says it's fully depreciated after about 3 years.
Laura, can I ask a question about this result of a kind of labor share fell? Is it within the firm you see that over time firms like hire more, like use more AI, or is it a composition where you see like, let's say, old-fashioned kind of shops are killed by fintech and I don't know, like some high frequency people? So it's kind of the composition changing rather than within firm trend.
We are not seeing a whole lot of exit. Let me show you what's happening to workers. So that's sort of a good segue. And, are we killing, I think, part of what you're getting at is, are we firing a whole bunch of workers? And interestingly, the answer is no. So what's happening instead is that data is growing and labor is growing. It's just that data is growing faster, right? So this is the total labor analysis labor stock, right? So this is old tech and AI, and they're both growing. And if you plot them, separately, they're still both growing. And we're getting estimates of the total data stock that seem like they're, so it's just an expanding industry, right? That became more productive. So they're not hiring fewer workers, right? They're just employing a different mix. And so I think that's, to get to your question, this is why we're not seeing the exit of lots of firms, because this is an industry in this time period that's just booming. It's just booming at different rates. So the other thing I wanted to mention, great, we've got a couple of minutes left, is that this methodology can actually value data. So, if you go back to way in the beginning, we've got a value function that's a function of this state variable, and the state variable is the stock of data. So once you've estimated the parameters of this value function, you can compute what is the value of this, a certain stock of data minus the value of zero data, or what's the marginal value of data? What's a V of D and V of D plus 1, right? And so this becomes a tool now you can use to say, how much is a certain amount of data worth, right? And so what's happening is the cumulative value of data is rising enormously, right? So this is just 2015 up to the end of 2018. And the value of data started at, this is like e to the 10th. So we're talking about, billions here, but it started here down below 0.25 and it's ending up at greater than 1.75. So multi-fold increase in the value of the total data stock, right? And this is about, the percentile of the firm distribution. A small number of firms, the top 10%, accounts for most of the increase in the total value of data. But most everybody is accumulating some more of this, or it's getting more value. So why, what's going on here? Well, there are a few different things. First, there's just more data, right? That's part of the reason that the value is going up. We've got more of it. Second is they're hiring more analysis workers, right? So if there are more workers to pair with data, that makes each data point more valuable. So the increase in analysis workers is contributing to the increase in value of data. And third, firms are becoming, more productive at using AI. And so this is actually, that's a terrible plot to make that point. Interesting, that got updated. Okay, well, well, we see the increase in AI here. It doesn't look like they're getting more productive at using the old technology data at all. And actually doesn't look like they're getting, according to the latest estimates, they're getting any better in this region. But, in that last period, there's some uptick in the productivity. But I would say, from this, what I take away is that not, the getting better at using AI is not as big a deal over this period as just getting more of it and hiring more workers to work with it. And this is what's increasing the value. Okay. So
Laura, I have a quick question. So you mentioned earlier the size distribution of firm, and then you showed us a plot of the big firm becoming larger. I'm guessing that what you meant at the beginning is that the less diminishing return might have implication for the size distribution of firm too. And I was wondering what implication it has and whether or not the implications are in line with what you see quantitatively or qualitatively.
I don't know. I'd have to work out an equilibrium model to figure that out, right? This isn't This isn't that.
Yeah,
This
no,
is
so it's a
one firm problem. I mean, I know that you'd want to know that parameter and it would be relevant, but I haven't, you know, expanded this to say, what does the whole equilibrium of the economy say about all of these, you know, about, you know, overall labor share. Well, I guess that should get down, but about the firm size distribution. I need to write down a richer model in order to do that. And
yeah.
I want to keep this.
This seems to show there's big change in the firm size too, no? Or perhaps,
I mean,
or maybe not the value, I guess.
Yeah, this is the value of the data stock they have.
Yeah.
I think intuitively I agree with you that those, you know, these yellow firms at the top are big firm, probably big firms getting a lot bigger, but that's not exactly what this actually shows, but it is suggestive. So, you know, there's other work that I'm doing to think about, you know, market power and how, you know, how this stuff might be affecting competition. And, you know, that is an equilibrium model. And, you know, so I'm sort of, you know, I'm pursuing this, but I haven't linked it up with this project where I can tell you like, well, exactly this change in the exponent means we should see big firms being, you know, 3 times bigger or something like that. You know, it's an agenda. I hope to get there, or maybe somebody else will, but I like the spirit of it.
Thank you.
Okay.
Laura, can I ask a question about the productivity trend?
Down at the end anyway.
So,
I'll just, yep.
Yeah. So if I think about data as acquiring information, then it could be that different firms are acquiring the same information. Could that explain, you know, this productivity trend? That initially it seems like productivity is going down, even though there's more data available.
I'm trying to pick apart this comment and make it. Can you express it again in a different way? I'm not sure what you have in mind. No,
what I meant is that right now we think of the data is just the same as other capital with a particular kind of production function. But if I kind of go a bit more into the micro foundation of data, if I think about it as information, then private institutions may be acquiring information. You have a lot of work on information acquisition. So we know that, you know, if firms acquire privately the information acquisition may be very inefficient, even though the technology to acquire information has been improving, because firms may be acquiring duplicate information privately.
Yeah, can I actually ask a follow-up question on that? Maybe you can answer them both at the same time, because I was thinking something similar, which is how is it seems like your chart of the value of data was just booming. Seems inconsistent with Grossman and Stiglitz, where, you know, at some point it's not worth bothering anymore if it's going to go into the prices anyway. Right. And it would only be consistent if at the same time prices were getting a whole lot noisier, which we probably don't really think is happening. So I'm just wondering, and this goes back to the last question as well, does all of this mean we should change the way we write down models of information and trading and all that stuff, which obviously you've worked a lot on in the past?
I think, okay, so part of what's happening is that there's data on a broader range of risks. So, you know, Grossman and Stiglitz is about there's one asset, or really there's one risk, not just one asset, but there's one risk in the economy, and we're researching the hell out of it. And at some point, that's not a very valuable activity, right? But you could imagine that there's an enormous number of risk factors out there, right? Some are quite large, and some are much smaller, and we're sort of working our way down the value chain. And so part of the reason that I think data isn't losing value at a rate that a Grossman-Stiglitz model might suggest that it would, is that when we accumulate more and more data, we're learning about different things, right? Different risks and different dimensions, different types of assets, right? Now maybe with AI, it becomes worth it to, you know, to start investigating small assets a little bit more. And in the past, when this was very labor intensive, you'd only look at, you know, large value firms or something like that. So, you know, this is consistent with the work that I've done with Mariam and Venki and Adrien on, you know, trying to value data by looking at financial market outcomes, right? So it's a totally different approach, nothing labor-based at all, but, you know, estimate what do we think a piece of knowledge, a unit of precision that forecasted a future return of an asset would be worth. And we're seeing changes in the value of different kinds of assets and how valuable they are to learn about. But we're not seeing that an additional unit of precision for any one of these is just plummeting. So these two sets of results from very different ends of the spectrum using very different data to impute these values make me think that there's some consistency here. I don't think this means that there isn't diminishing returns in the aggregate. I just think that firms are working really hard to fight against it by finding new frontiers and new dimensions to learn about. Does that answer both questions? Or did I ignore the first one?
No,
I think I ended up hijacking the first one. I apologize. I think maybe you want to come back.
No, just a broad question. So I don't think there's no answer. It's just open-ended question. It's okay.
So I have another question a bit on that same theme. From the job description that you analyzed, do you know a bit what is the AI job about? How is AI used? Is it for trading in markets, for risk management, is it to maybe discover those new or learn about some new industries, or manage better different risks that were overlooked, as you say? Is there any clue about the use of those of AI in those firms?
I don't think the risk management bit would be done by somebody called a financial analyst. I think there'd probably be a separate department for doing that, and that's an important category of use of data. And
perfect.
But I think the other examples you mentioned are all things that might be done under the rubric of this kind of job, right? So looking at new industries, or investigating smaller firms, or just processing loads of macro data, or any of these, are some job postings specific about we want somebody with expertise in this area? Sure. We're not really sort of teasing those out, but I mean, that's something that this sort of textual analysis tool could do, right? If our objective was to figure out, I do think this raises questions about what are they using this data for, right? And one could go back to some of these job descriptions and try to figure that out. I do think some of these firms are going to be a little hesitant to reveal exactly, our big strategy is to go investigate, the small growth technology space. So I'm not sure they'd want to post that in a public job, but we can see how much, could be extracted from what's there about that.
Yeah, I guess just following up on Pierre's question, if you can show us the value function again for a second, is that possible? Or
absolutely.
I guess maybe this is the same question, but I guess an assumption here that's kind of unstated is that KOT and KAI are perfect substitutes, no? Like it's just, yeah.
They're each whatever a dollar's worth of knowledge is. Right, so $1 is $1. They don't have to be the same knowledge about the same stuff, but they each have to be worth $1, and you have to care about total dollars in your pocket. Is that?
I don't know. I could just imagine a formulation where there's some, again, substitution between these two types of knowledge, and it may not be perfect.
I think that's right. I think, yeah, but I don't think, if as long as this KAI can be put into some future production function to generate you a marginal value of $1, and the KOT can be put into some production function to generate a marginal value of $1, if you're going to use them in different ways, maybe the KAI is for like trading on order flow, and the KOT is for like, doing speculation on macro risks and market timing. I think that's not problematic here, as long as, they both have a marginal value of $1, and at the end of the day, you like total dollars.
I have sort of a question in a similar spirit, but before, are we in the BSing part of this? Because it's kind of a big picture question. I wanted to make sure you had finished.
I've said everything I need to say. Yeah. I think
All right,
you
so I guess like the sort of big picture question is, it's like you chose the financial industry that you did here. And I can see there's some advantages to that, but then I guess one challenging thing, which maybe some of these questions are getting at, is like, if you had chose like biotech, then like there's some sense in which like the value function depends a little bit less on what everybody else is doing, right? I mean, you use AI to discover a new, but here the value function depends very much on whether everybody else has also using AI, because that affects the prices, and then the how much my trading strategy depends on anyone else. So I was just kind of asking, I guess, a broad question about what caused you to choose this particular industry.
We knew something about it. That helps, right? I mean, you do kind of need to know the vocabulary. I mean, one of the things that I learned from this is, I usually write models of a whole economy and don't really worry about, sectors, job descriptions, and so forth. But if you want to make fine distinctions between jobs, it's going to be awfully hard to do this for the whole economy.
I see, in the textual analysis and all that kind of stuff.
To do the textual analysis, because they use different vocabularies to describe what's the kind of job. What do you call somebody who combines data and labor and turns that into an actionable, proposal, or, it makes an action recommendation or trades on it, or, builds biotech whatever on it, right? They're going to use different words. So it's really about the textual analysis of the jobs. But also that finance is really an industry. Now, maybe biotech is also an industry leader in this, right? But let's say marketing is, you can use AI in marketing. Is there a ton of this? Is this really widespread? Not so much. And even in finance, you saw that fraction is low, right? That those AI jobs way less than for any other sector. I don't know. I mean, maybe a high technology, biotech isn't, but for most other sectors, this is going to be even lower. And so, what we're trying to do is learn something about a new technology that's just at the beginning of its adoption, right? It's sort of like we're at the beginning of the Industrial Revolution, and there are only a few factories being built in this one area. And we're trying to look at what's going on there to learn something about what's likely to happen down the road to many other, sectors or, urban areas or whatever, and sort of project forward. So we got to use the richest source of data. But
sure.
Maybe biotech would work. I think the main limitation, I agree, that's probably an early adopter.
Yeah, I was just trying to think of like conceptually a thing where I see like AI just mapping straight into sort of more output, more productivity, whether it's like restocking shelves better or whatever. Conceptually, that seems like it's mapping into something more sort of exogenous in some sense, as opposed to like the value depending precisely on what everybody else is doing. But I mean, I take your point.
Yeah, I mean, I think there's other industries that are less strategic. On the other hand, if somebody else invented your biotech thing first, the payoff to doing it.
Yeah, no, sure, it's not perfect. I agree.
There's some element of that there as well. But yeah, it's got its own challenges and advantages in every industry. But I think partly we came at it like Ansgar said, we had a bunch of students who were like, hey, we know machine learning tools and we want to go get jobs, and what can we do in this industry? And it seemed to be, all of a sudden there was a flow of job postings and student interest in learning these skills to get these jobs, and that that was part of what led us to look in this corner of the economy.
Maybe I can just follow up on Ben's point. I think that my sense is exactly what you said, that it's just very beginning, and for finance, it's still very beginning. So we looked into artificial intelligence professors who leave universities to go to industry, and most of them go to robotics, most of them go to self-driving cars. I think that finance, you can see there are some notable cases where Carnegie Mellon lost the chair of their computer science department to JP Morgan, but it's still a very small fraction. So in that sense, I feel that what you capture and what you estimate is as you said, it's maybe just the beginning of the wave that will in the next 10 years be much more prominent. And in terms of suggestions, maybe one way to try to get a better sense, to kind of within this 3 years time period, to try to get a tighter estimates of this particular wave. If you look specifically on PhDs, if you look specifically on keywords like deep learning, which seems to be like, you know, the high tech of AI, then maybe you can like get like additional bump into this estimate, this difference in the like, you know, labor versus like a data. And I think that it will just help you to kind of project forward what we should expect, given that it's really a very beginning, and we should expect much more like, you know, in AI intensive propagation into this industry that you're looking at.
So you're, just to be clear, you're proposing a third, or I guess now a fourth category of labor, a third category of analysis that's the highest skill among the AI workers.
Or alternatively, it's just to say everyone who does deep learning is AI, everyone who doesn't do deep learning is not an AI. So you put like much more stringent requirement what would classify as AI. So if you're just using some package that someone invented, it's not really AI. And then you start to get into the very top of the people who are the most productive, and they can make this data speak stuff that you don't even expect it to know. So that's, I think, is the proposal.
A lot of our finance students know how to plug TensorFlow into Python and, you know, hit the right button and get something out of it. And I do think a lot of these jobs allow for that kind of skill. And that's very different from knowing, you know, what it is exactly that you're doing, right? And we see a lot of wage heterogeneity that I'm sure reflects that as well.
Laura, do you have a sense of, sorry, we're out of time. Should I stop asking questions, or have we got time for one more?
No, it's okay. We can continue. So I can officially end the seminar, and we can continue as long as you, Laura, would like to.
Sure. I'm happy to keep chatting.